What happens to the inflation when there is a negative supply shock to the economy? There's two avenues for this to happen. We can either have a rise in the input prices, wages are getting higher, capital costs are higher, intermediate goods are higher, energy prices are higher, or you can have a productivity shock. So this would be like the fall of the Roman Empire. The economy was not able to operate at the same level of efficiency that it used to. So here's our beautiful little Phillips curve. We're going to have an unexpected negative cost shock. Now remember that the Phillips curve was used to model changes in demand. A negative supply shock will shift that Phillips curve up, and giving everything else the same in the economy will lead to higher inflation at every output gap. Unexpected inflation is now 2 percentage points higher than the expected level. An example of this would be the oil shocks that we saw in the 1970s. Relatively speaking, the price of a barrel of oil was relatively low for decades, and then in the 70s, it skyrocketed. $3.50 a barrel, $10 a barrel, $14 a barrel, $40 a barrel. For reference, we saw $40 a barrel briefly in 2016, and again during the pandemic in 2020. Looking at it as a percentage change from a year ago on an annual basis, the price of oil jumped 167% in 1974. 66% in 1980. Positive double-digit changes in the years between. While we've had a few spikes in 2000 or 2008 or 2021, we haven't seen anything sustained year-over-year positive in the years since, and especially not in the years before. We could also have a productivity shock. In this case, we'll show a positive productivity shock. We'll model this by shifting the Phillips curve down, which means at every output gap, we will see unexpectedly lower inflation. And at this particular spot, the inflation rate is 2 percentage points below expectations. So if the expected rate is 2% and you have negative 2% of unexpected inflation, the observed inflation rate will be 0 in our made up numbers here. This happened to the economy in the late 1990s. It was a period of very strong economic growth. This graph shows the output gap, and we see for the entire upper half of that decade, real GDP exceeded what was believed to be the potential GDP. The economy was running hot. However, do you know what we did not observe? Irregular inflation. In fact, between 96 and 98, the inflation rate dropped a bit, and it still remained in the normal range after that. So, what's going on? The output gap was positive. If we use the specific numbers, we'll throw in 2% here. Yet, we did not see this. Something else is going on in this economy besides a positive demand shock. In the late 90s, the internet and personal computing productivity boom was in full swing. We were able to do things with less time, less energy, and more efficiency than ever before. And so this is going to cause a shift in the Phillips curve. A positive productivity shock means that every demand level, excess demand, insufficient demand, we will see lower inflation than otherwise. The best kind of shock you can always have is a positive supply shock, because we are doing more with less, prices go lower, and we get more stuff. And here we see it in the macroeconomy as well. We have a tremendously growing GDP without experiencing inflation.